So our next question comes from Carson D. And Carson says, "Hi, Austin and Robert. I want to get your thoughts on an opportunity that I'm considering. I'm single, 22 years old, and I'm a college student graduating this spring. I'm fortunate enough to have a solid financial position with a net worth of about $225,000 that is mostly held in a taxable brokerage account. A significant portion of this came from the acquisition of a company I had a very small stake in. I expect to receive an additional $250,000 when the company goes public, which could happen in the next several years. My current internship will transition into a full-time job after graduation. Over the past year, I've been able to save about $1,000 per month after expenses. I recently started contributing to a Roth 401k through my employer, and they're matching my contributions. Here's where I'd specifically like your input. I work at a financial firm with a strong private equity division. Employees who qualify as accredited investors, which I hope to meet through professional credentials, can invest alongside the general partners fee-free. The firm's track record is impressive, ranking highly among growth private equity funds, and I expect a new fund to open shortly after I go full-time. I'm excited about the potential for strong compounded growth so early in my 20s, but the investment would likely be locked up for 5 to 8 years. I'll be living with my parents initially out of college, so my expenses will continue to be low. While I'm comfortable with taking some high-conviction concentrated bets, I don't want to overextend myself at a young age. Keep in mind, the commitment is called over several years. I'd really appreciate any advice or thoughts you have on how much to commit, as well as how to approach this opportunity, and just anything you have to share about this. Thanks, Austin and Robert. Can't wait to hear your thoughts. You want to kick this one off, Robert?
I love it. Carson, great job. I love to see young people crushing it that understand, you have to put in the work. You have to have the knowledge. You have to really, dig in and get dirty to build wealth, especially at an early age. So I love this, all of it. Here's what I would say, and you alluded to it. Keep in mind that any of these venture investments you're going to make through private equity are going to be tied up for a very long time. You already know that. So as long as you understand whatever portion of your investable capital that is going into these deals is likely going to be tied up for that 5, 6, 7 years, then I'm okay with it. Otherwise, I would say I would wait a little bit longer, get your net worth up a little bit higher. I don't like to see people doing private equity deals, with, a net worth of less than $1 or $2 million. But I'm okay with it because you're smart. You understand the platform and that aspect of investing, and you already have a really good base built. And I would look at it that maybe your buy box for these private equity deals is only 20% of your net investable capital. I spoke to a friend yesterday. I believe he's 28 years old. He's all in right now on crypto and one venture deal. And I think that's scary because if this startup doesn't work, then 50, 60% of his net worth that he's been working towards over the past few years is going to be gone because a lot of startups and private equity deals do go to zero. So just keep that in mind. I love where your head's at, and I am totally all about you doing it, but just make sure you understand that it's illiquid and the time frame around it so you don't get yourself put into a cash situation where you're cash broke and you can't get to enough money you need for other opportunities.
Yeah, I'm right there with you, Robert. I would even go closer to 10% of this 225,000, net worth, right? If you wanted to take 20 to 25,000 of your money, right? 10% and roll the dice, right? Because that's what this is doing. You're rolling the dice for 5 to 8 years, and maybe it turns into 100,000 or 150,000 because, this private equity growth fund was able to invest in some really cool startups. Like, congratulations. That's your down payment for a house when you're older. Or if it goes to zero, you knew your risks. But I think to Robert's point, what's really important to consider here is you need to have a higher net worth before you really think about doing these types of things. It's called an accredited investor credentials for a reason. You have to have $1 million net worth to be an accredited investor or make $250,000 a year for 2 years. You're trying to go around this a little bit with your professional credentials, which just means you passed a couple tests and you know what you're talking about, which is true, but they make it so that you have to have a lot of money to participate because they know that if you'll, make the wrong bet, you could lose a lot of money. So I'm right there with you, Robert. I think that, this is a really cool situation to be in. If I was Carson, I would just rather Carson put a little bit less maybe than what he might have originally been thinking. Let's call it $20,000 to $25,000, and then continue to invest the money you do have into long-standing index funds and ETFs that we talk about. Do not make the mistake that Robert and I both made when we were much younger, which is going all in on a single stock or a cryptocurrency or a venture startup, right? we've done those things and we've made those mistakes so that you don't have to do that, right? I've talked about it all the time. I lost $75,000 of my hard-earned money by investing a little too aggressive in the early days into a venture startup that ended up going to zero. It sucks. There's nothing worse than losing hard-earned money, especially from a successful exit that you've already had, which is really cool. So just make sure you're doing everything right as it relates to your tax advantage accounts, thinking the Roth IRA, the HSA, the Roth 401k, and then also think about what you can do with that bridge account. It seems like you got a ton already in a taxable brokerage. When do you want to retire, right? You've already, done a really great job building your wealth. 40-year-old retirement could be around the corner for you, Carson. You just have to think about what those goals might begin to look like, and then don't forget about real estate. You mentioned you're living with your parents. I've never met anyone with a $250,000 net worth that's living with their parents. My favorite saying is the eagle that never leaves the nest turns into a turkey. Do not turn into a turkey, Carson. Leave the nest eventually. Just go be on your own and live your own life.
I've got one more quick takeaway and then we can sign off for Carson and anyone else listening. The biggest lesson I learned in private equity and venture investing over the last 15 or 20 years of doing it is to write more checks that are smaller than going all in on one or two deals, because you just give yourself more opportunities to win, because many of these investments are going to go to zero. And so that is the key that I would use, is when you're thinking about this strategy, just write smaller checks over more investments, because if you hit a big winner, it's going to be a great windfall anyway. That's how I do it. And it has worked so well for me over the years once I learned that.
And what sucks too is I'm sure Carson's kind of just like, oh yeah, I'm 22. I'm investing into funds. I'm well on my way. Like I'm doing this, I'm doing that. I had the exact same mindset. I was 24 when I invested in my first fund, 24 when I invested in my first startups, right? I totally know what you're talking about. And it feels good to be young and doing these things. But man, I feel like I would have felt better if I used that money to go buy a duplex, or I would have felt better if I used that money to go, see my first 250 or 300,000 in VOO, buy my first 1 or 2 Bitcoin, whole Bitcoin, right? So there's just like having that liquidity means a lot. And you don't realize you like it so much until you have it, or until you don't have it, right? And so just give yourself some perspective here, Carson, and we're rooting for you, man. You're doing a really great job. Just don't get ahead of yourself, because you are at this position where if you make too many big investments or make the wrong investments, all of this 250,000, 220,000 that you've got right here could easily turn into 46,000 because you got too risky. And you are at a point where you can have tens of millions of dollars in retirement with this kind of money.